welcome everybody to the latest episode in the Record Currency Management podcast. I'm Torrie Callander and I'll be your host. So 2020 was certainly a tumultuous year for markets. I think we can all agree on that. But the latter part of the year was characterized, I think it's fair to say, by increasing positivity. And indeed, as we came into 2021, the reflation trade was a big driver of a strong performance in risk assets. However, just as we come to the end of Q1 and the beginning of Q2, we're beginning to see some pockets of stress just in certain areas or certain corners of the market, as well as a bit of a regime change, it feels, in some asset classes, particularly around rates and currencies. So it felt like a very suitable time, or the perfect time, to get together with our head of macro strategies, John Floyd. So John, welcome to the podcast. Now, throughout the latter part of last year, I think it's fair to say that you were outspoken in your view that certain elements of the market might be underpricing the probability of certain events and overpricing the probability of certain other events. So perhaps you could just give us a quick rundown as to where you saw the mismatch then and how you feel about the way things have played out so far.
Thanks, Torrie. And you're absolutely right. It's wonderful to have this timely conversation as markets clearly are in train. And what makes the current environment all the more exciting is my belief that we are in the greatest macro investing environment of our lifetimes, particularly as it pertains to the currency markets. But more about that in a few minutes. You are correct. Entering Q1 of 2021, I thought there were several areas where the probability of outcomes was mispriced, particularly on the immediate horizon. I expected that the key market drivers were going to be centered around the reflation trade and relative global monetary and geopolitical responses, as well as the vaccine distribution. In the US, with the new Biden administration aiming for substantial additional fiscal stimulus, it became clear that the Georgia runoff elections could be a watershed moment. In addition, our internal analysis and monitoring of polling and voting trends indicated the odds favored the Democrats. The combination of such an outcome, along with historically low interest rates and markets that were not fully pricing such an outcome, left open an asymmetric market response, which indeed we've seen over Q1. In addition, linked to this thesis was the idea that the market is too soon in anticipating the demise of the US dollar. Our proprietary models coming into Q1 showed that market positioning indicated an extreme US dollar short across multiple currency pairs. The expectation that we had was that a shift to more aggressive fiscal policy in the US and the subsequent move higher potentially in yields, combined with what we modeled as better relative vaccine distribution in the United States compared to much of the rest of the world, created an opportunity for long dollar exposure with controlled downside through both outright positions and through options. And that thesis is just now beginning to really play out. And perhaps to quote Mark Twain, one might say about the dollar, reports of my death are greatly exaggerated.
Okay, great. So looking ahead from here, do you feel like markets are now better evaluating the situation and sort of pricing the probabilities?
Well, yes. Torrie, to an extent, markets are beginning to move and adjust to some of the unfolding narratives that we envisioned. But opportunities remain rife, and the ability to generate a variant perception and ask the right questions, provides the basis for optimism of the tremendous perspective opportunities. One thing, to keep in the mind's eye is that we're living in what can be termed, an everything bubble. Markets across asset classes, whether it be equities, credit, interest rates, or others, are all showing varying characteristics of being in bubble territory. The bubbles have expanded even further by the fiscal and monetary responses to the pandemic. If you look at equity valuations, for example, as measured by the Shiller-Cape ratio, they've only been at this level 3 times in the last century. High yield spreads remain divorced from reality. So what happens if interest rates do rise further and defaults pick up? And what are the knock-on effects and feedback mechanisms across asset classes? Conversely, what happens if low interest rates persist these bubbles may remain longer than anticipated by the markets, and that also presents opportunities and challenges going forward.
Sure. And John, that's really interesting. But some of that, I guess, might take a bit of time to unfold. So what do you think about the more immediate term?
Yes, I mean, the challenge in investing is always picking your time frames and picking your investments and structuring the portfolio accordingly. In the more immediate term, there are several questions to ask about the current market narratives and how they might impact market prices. Globally, the market consensus right now is expecting the reflation narrative to continue. For example, some US growth expectations are as high as 8% in terms of GDP. Inflation is expected to continue to rise, and employment is expected to continue to move lower. Is that going to happen as the market expects? What are the respective probabilities, and what are the consequences for asset prices if it plays out as planned, or if it plays out different than the consensus expects? And first, in terms of both growth and inflation, there are several key issues. One, does US fiscal stimulus at 3 times the size of the stimulus during the global financial crisis of 2008, combined with the low monetary policy, lead to an acceleration in both growth and inflation? And one key to note here is the situation is much different today than 2008. In 2008, the consumer was in much worse shape. Today, the consumer household net worth is very strong and savings rates are very high. An underappreciated risk on the inflation front is a shift potentially in globalization and the bringing back of supply chains to the US. One characteristic of the 20th century has been a significant move higher in inflation. And that's been driven by a number of things. Both population growth and fiat currency systems have been some of the keys. For example, if you look at a recent DB study, UK overall price levels were broadly unchanged from 1800 to 1938. But since 1938, inflation has averaged around 5% per year, bringing the cumulative price increase to just around 5,000%. So a combination of weak wage growth, record global debt levels of 332% of GDP, continued technology innovation, and a consumer that may bear lasting scars from the pandemic may choose to be more cautious in spending and cause both global growth and inflation to remain below expectations. The key period we've highlighted is from July forward as we move towards a fiscal cliff and policy starts to be contractionary and vaccine distribution and herd immunity accelerate.
Okay, great. Thank you. And it sounds as though there are a few cautionary notes, shall we say, there that you might want to share with our viewers.
Absolutely. I mean, there always are cautionary notes. And a few of those are that the consensus might be wrong in several areas. The last time fiscal stimulus was withdrawn, the economy began to slow. And we're actually seeing some of those signs of weakening now, particularly in the housing and auto markets. On the wage front, the workers returning to the labor market post-pandemic are also going to be lower earners, so wage growth may be challenging. In sum, given slowing government spending, an uncertain consumer and investment outlook, combined with the weaker export picture given weaker growth in the rest of the world, current GDP expectations may be a challenge to meet.
Sure, thank you. And that makes a lot of sense. Just if you wouldn't mind, any thoughts on emerging markets, which seem to be gaining ever increasing focus at the moment?
Yes, I mean, clearly emerging markets are going to be a very important sector to watch as they have a record debt mountain, which now is $4 trillion in US dollar denominated debt that they need to service. In addition to that, emerging market economies are in very much worse shape than they were, say, during the 2013 taper tantrum. For example, if you look at South Africa and Brazil, both have debt levels that are roughly the size of their economies and budget deficits that are well into the double digits. Combining that with a weak macroeconomic picture are divisive politics and poor vaccine rollouts. Our high frequency data that we've been monitoring are already starting to show some reversal in capital flows. And if this were to accelerate, the implications for both EM and the US dollar would be significant. In terms of looking more broadly, at the US dollar, it's likely to remain the world's leading reserve currency given the lack of an immediate viable alternative. Importantly, in the shorter term, the US economy is likely to continue to outperform much of the rest of the world and continue to be the beneficiary of capital inflows. Should the US economy perform weaker than the market expects going forward and market interest rates decline, that will definitely be a headwind for the dollar. But currencies are a game of relatives, and much will depend on relative growth and relative interest rates. And US exceptionalism and outperformance looks to remain intact as a net positive for the US dollar going forward.
Okay, great. Thanks, John. And we've covered, or you've covered, to be fair, a huge amount of ground there. And I really appreciate that. I think just to finish, or to move on to the last section, as you might have expected, I'd like to talk currencies specifically. You have said in the past, and continue to say, that currencies will act, or could act, as the great equilibrating mechanism as we move forward in markets. And I was just hoping you could explain what you mean by that.
Yes, absolutely. What I mean by currency markets being the last great equilibrium mechanism is there likely to be, the escape valve or the unconstrained policy lever as we move through financial repression, and we are reaching some limits on both monetary policy and fiscal policy. The exit from financial repression will mean either growth, inflation, or debt restructuring. In any of these exit plans, the fiat currency system is likely to witness massive exchange rate movements as a result of differentiated courses each country follows and the market's expectations of future prices. In the not so distant past, there were substantial currency moves as an escape valve. For example, the US-led Fed with Chairman Volcker and the extreme tightening saw the US dollar rally versus the euro equivalent by over 50%. The ERM crisis saw the British pound depreciate by over 20%. And for the past 20 plus years, the Japanese yen has appreciated against the dollar from over 300 to the current levels around 110. If you look at the shorter term, currency volatility during the pandemic was actually much lower than during the global financial crisis. And currency volatility is now averaging around 6 to 7%, which is approximately 1/2 of where it was 40 years ago. Of particular note, as a crack in the low volatility edifice, so to speak, is the recent German Constitutional Court decision as regards the Eurozone Recovery Fund. At a time when France is announcing new lockdown measures and countries like Italy and Spain are in desperate need of help, this raises serious questions about what has been termed Europe's Hamiltonian moment. The likely advent of the coming secular changes in globally linked inflation dynamics, convergent growth, and monetary provisioning is likely to lead to volatility rising across all asset classes, particularly the currency markets, as the gem or the great equilibrating mechanism. I think a good way to conclude this great and timely talk, Torrie, which I really appreciate you hosting, is with a thought from one of the influencers earlier in my career, Rudy Dornbush. And Rudy liked to say, things take longer to happen than you think they will. But when they do happen, they do so faster and go a lot farther than you think they could.
Yeah, it's a bit like Hemingway, where he said, how did you go bankrupt? It's like slowly at first, but then really fast. That's a misquote, but not far away.
Exactly
Sure.
right.
Listen, thanks, John. I think that's been a great, I wouldn't even call it an overview because you covered so much ground and so much detail with a lot for our viewers to take away. So as ever, we hope that that's been useful for you. We're happy to answer any questions you have, and otherwise, see you next time. Thanks, John.
Thanks, Torrie.